Hello and welcome to video 3 of lesson 1, in which I discuss supply and demand for gold. Supply and demand. The supply and demand dynamics for gold are entirely different from other commodities. The vast majority of gold is not consumed as there is little industrial use for gold. Therefore, its supply grows virtually in perpetuity. The majority of demand for gold comes from jewelry demand and investment demand, which is the demand driver of the trend in the gold price. Jewelry demand trends inversely to the price of gold. When the gold price rises, jewelry demand falls. Conversely, jewelry demand increases when the gold price declines. Investment demand is the mirror image of jewelry demand. It correlates positively to changes in the gold price. Evidence of the importance of investment demand is reflected in figure 1.6, which is from CPM Group. Investment demand tends to increase in the years of an increase in the gold price. Changes in investment demand have continued to drive the price of gold in the most recent years. According to data from the World Gold Council, investment demand in 2019 increased to roughly 45 million ounces. Then in 2020, investment demand surged to 62.4 million ounces. However, after the gold price peaked in August of 2020, investment demand plummeted to only 35.5 million ounces in 2021. Investment demand should finish 2022 with a modest increase, as gold has outperformed most asset classes. When gold has bullish fundamentals, such as declining real interest rates, investment demand increases materially and the gold price rises. If investors discount rising real interest rates and weaker fundamentals for gold, investment demand declines, and so does the gold price. Central bank buying. Aside from investment demand and jewelry demand, the other categories of demand are technological and central bank demand, whose impact is different today than in decades past. Central banks were net sellers during most of the 1970 to 1980 and 2001 to 2011 bull markets. They became net buyers only at the very end of those bull markets. As shown in figure 1.7, central bank demand historically was inversely correlated to the gold price. Assuming that the 2022 low in gold is a major low, increasing central bank demand can signal a bottom in the gold price. Figure 1.7 and figure 1.8 below show that 2018 saw record central bank demand until 2022. While the gold price bottomed at $1,045 an ounce in December 2015, the August 2018 bottom at $1,167 an ounce was more significant because the gold price gained 80% over the next 24 months. Central bank gold demand through September 2022 has already eclipsed demand from 2018. Gold emerged in November 2022 from what appears to be a significant bottom. If that statement holds up a year from now, then we can verify that central bank demand can provide major support for the gold price during a downtrend and even help to reverse it. However, it is important to note and understand that central bank demand is not necessarily a consistent indicator of the trend in the gold price. Central banks tend to be poor market timers. Recall that they were net sellers until the very end of 1970 to 1980 and the 2000 to 2011 secular bull markets. They were net buyers in the early and late 1980s and were heavy buyers from 2011 to 2013. Their market timing has improved over the last 5 years, but the historical record is poor. Geopolitics. Contrary to popular opinion, geopolitics play only a minor role in gold price movements. Unless geopolitical events directly impact the direction of interest rates or inflation, their impact on gold would be short-lived. Geopolitical happenings in the 1970s affected gold because they usually moved the oil market, which is an important driver of inflation. The year 2022 provided a textbook example of the fleeting nature of geopolitical catalysts. As Russia prepared to invade Ukraine, the gold price quickly moved from $1,780 an ounce at the end of January to a peak of nearly $2,080 an ounce within 5 weeks. In 2 months, gold gave back all of those gains. The market sensed an imminent peak in the rate of inflation and the start of a very aggressive rate hiking campaign from the Federal Reserve. Global gold production. Unlike other commodities, gold is not consumed, and therefore its supply is always growing. Gold moves on the margin due to monetary factors and investment demand. Broad supply and demand and production fundamentals for gold are essentially meaningless. However, there is one interesting observation we can make regarding the global production of gold. Figure 1.9 shows the annual global output of and demand for gold dating back to 1950. From the chart, one might think that production impacts the gold price. It declines when the gold price is rising, but rises when the gold price is falling. I credit someone with the moniker Trotsky, who has a great explanation, courtesy of Mike Shedlock. According to Trotsky, mining companies are forced to high-grade their mines during low gold price environments. In other words, they mine the higher-grade, lower-cost portions of their deposits. However, when the gold price rises, mining companies can mine the lower-grade portion of their deposits. In addition, the impact of the gold price on future supply operates with a considerable lag. Gold bull markets lead to greater exploration spending, which leads to more future production. However, the gold bull market has run its course by the time those new mines are operating. Furthermore, the impact of a gold bear market on future production is not realized until the time when gold is back in a bull market. The inverse relationship between global gold production and gold prices has continued in recent years. Production declined from 2018 to 2020 when the gold price enjoyed a cyclical bull market, and production increased in 2021 along with the gold price, which declined in price. That concludes Lesson 1. Thank you for watching. Next up is Lesson 2, in which we will discuss the very important relationship between gold and the stock market. Thank you.